Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing language of corporate filing so you can understand what is really going on. Today we're diving into CDW Corporation's 2025 annual report. And let me tell you, it is packed with numbers that tell a story. Make sure you are subscribed if you love getting the real scoop on companies. And join our Discord community linked in the description for more discussions like this. So what exactly is this document? Well, it is CDW's official report card for the year ended the 31st of December 2025. Think of it as the company telling investors and the public how they performed across the whole year, covering everything from their business operations to the nitty-gritty financial details. Let's jump right into the numbers. As of the 31st of December 2025, CDW reported total assets of about $16 billion. That is a lot of stuff the company owns and uses to make money. Now, what is interesting is how much of that is current assets, meaning things they can turn into cash within a year. That is over $8.5 billion, a huge chunk of that. Nearly $6.3 billion is in accounts receivable. This means money that customers owe them. When we look at what CDW owes others, their current liabilities are over $7.2 billion. A big part of that is accounts payable trade, coming in at over $4.2 billion. This is what CDW owes its suppliers. It is always a good sign when a company can manage its payables effectively. Now for the bottom line, the numbers everyone really cares about. For the year ending the 31st of December 2025, CDW reported a net income of over $1 billion. That is the profit after all expenses are paid. Compared to 2024, that is a slight drop of about 1%. While still a huge profit, it is worth watching if this trend continues. Let's talk about profitability, their gross profit margin, which is essentially the money left after accounting for the direct costs of selling their products and services, was 21.7% in 2025. This is a tiny bit lower than the 21.9% they saw in 2024. While it might not sound like much, for a company of this size, even small shifts can mean a lot of money. It suggests they might have had to lower prices or deal with higher product costs. The company spent over $3.2 billion on selling and administrative expenses. That is a pretty big jump of 9% from the previous year. They mentioned this is due to higher performance-based compensation, costs related to transformation initiatives, and coworker-related costs. Basically, they are investing more in their people and their future project. Looking at their operating income, which is the profit from their main business activities before interest and taxes, it came in at around $1.65 billion in 2025. This is just slightly higher than 2024, showing they're holding steady. However, the operating income margin dipped a bit from 7.9% to 7.4%. This reinforces the idea that increasing expenses are eating a little into their profit from daily operations. CDW also reports non-GAAP numbers, which adjust for certain one-time or non-cash items. Their non-GAAP operating income margin was 8.9% in 2025, down from 9.3% in 2024. This shows that even when you strip away some of the unusual stuff, the underlying profitability trend is similar, a slight decrease. On the top line, their net sales grew by 6.8% to reach over $22.4 billion. This means they sold more products and services than the year before, which is always a good sign. They saw growth across all their segments, which is a positive indicator of broad demand. Let's break down where that sales growth came from. Their corporate segment, which serves larger businesses, saw net sales increase by 6.8% to about $9.4 billion. This segment is still their largest. The small business segment also had a strong year, with net sales jumping by 13.3% to over $1.7 billion. This is a significant growth rate, showing they're effectively reaching and serving smaller companies. Their public segment, which includes government, education, and healthcare, grew at a more modest 4.6%, reaching over $8.5 billion. Here, net sales in education actually saw a slight dip of 1.8%, while healthcare showed strong growth of 13.3%. This mix is important to watch, as government and education spending can be unpredictable. The other category, which mainly covers their UK and Canada operations, saw a solid 9.7% increase in net sales, bringing in almost $2.7 billion. This international growth is a good sign for diversification. Looking at what they sell, hardware still makes up the biggest piece of their business, forming over 71% of net sales. Specifically, notebooks and mobile devices brought in nearly $5.7 billion, a notable increase. Software sales also showed healthy growth increasing by almost 19% to over $4.2 billion. This indicates that customers are trusting CDW not just for hardware, but also for their software needs. Their services segment also grew by over 9%, reaching more than $2 billion. This is crucial because services often have higher profit margins and build deeper customer relationships. Now, let's talk about goodwill. This is an accounting term that represents the value of a company's brand, reputation, and customer base over and above the value of its physical assets. CDW has a substantial amount of goodwill on its books, over $4.6 billion. This usually comes from past acquisitions. They perform regular checks to make sure this goodwill has not lost value, and so far, it looks like it is holding steady. CDW has a clear policy against insider trading, which is standard for publicly traded companies. It is there to ensure fairness and prevent people from using non-public information for personal gain. The auditors, Ernst & Young, gave a clean opinion on the financial statements. However, they did highlight revenue recognition professional services as a critical audit matter. This means that the way they recognize revenue from their professional services, especially for fixed fee projects, requires significant judgment from management. They have to estimate total project costs and the level of completion at any given time. While the auditors felt confident in CDW's methods, it is an area that requires close attention due to the estimations involved. CDW is very aware of the risks associated with cybersecurity. They have a dedicated Chief Information Security Officer, and their security management program is ISO 27001 certified. They also conduct regular penetration testing. While they haven't experienced a material cybersecurity breach, they acknowledge the evolving threat landscape, especially with the rise of AI, which could be used by malicious actors to enhance their attacks. Now, turning to their risk factors, they've got a pretty extensive list. A major one is their reliance on vendor partners like Apple, Cisco, Dell, HP, Lenovo, and Microsoft. Their relationships with these giants are key, and any changes in those partnerships could impact CDW. They also point to substantial competition, the complexities of AI adoption, and the potential for data security breaches as significant risks. CDW carries a considerable amount of debt. As of the 31st of December 2025, they had over $5.6 billion in total debt. This high level of debt means a significant portion of their cash flow goes towards paying interest and principal. This can limit their flexibility for investments, acquisitions, or even returning more cash to shareholders. Looking at their stock, there were about 129 million shares outstanding as of mid-February 2026. This is a pretty standard number for a company of this size. It is important to note that the stock market value of CDW's common equity held by non-affiliates was over $23 billion as of the 30th of June 2025. That is a massive market cap, placing them firmly in the large accelerated filer category. Their stock performance comparison shows that from the end of 2020 to the end of 2025, CDW's stock value, including reinvested dividends, actually went down, ending at $110 for every 100 invested. In contrast, the S&P 500 saw a significant rise, and the Information Technology Index did even better. Their peer group also outperformed CDW over this period. This is a really critical point. While the company itself is growing its sales, its stock price hasn't kept pace with the broader market or its peers in this specific time frame. This can happen for many reasons, but it suggests investors might be concerned about their debt levels or future growth prospects compared to others. So, what is my take on CDW's report? On the positive side, they are growing their sales, and their services and software segments are expanding, which is a good sign for future profitability and customer loyalty. They also managed their inventory well and improved their cash conversion cycle. However, the slight dip in profit margins and the significant increase in operating expenses are areas to watch. The high debt level remains a concern, potentially limiting their future financial flexibility. And let's be honest, the stock performance compared to the market and peers over the last few years is a red flag that investors are picking up on, suggesting they might be seeing greater risks or slower future growth compared to other tech companies. What is your take on these numbers and what they signal for CDW's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.